Pump Director Quality in one of the big MNCs. So over to you, Mr. Balaji.
Good afternoon again. So I'm going to be talking on a topic which all of you will be wondering, why is this topic even being spoken about? Because related parties is something which we get concerned with every day in our audits. But I thought I should bring out 2-3 pointers in the related parties, which is sort of disturbing me and should be actually worrying for the profession also. And we should all collectively see what better can be done in related parties. Morning, we were talking about the trust in the financial statements. And the trust in the financial statements is increased by enhanced qualitative disclosures. And one of the significant impacts on the financial statements is related party transactions in the Indian context. Because Indian context, related party transactions are definitely pervasive to the financial statements and gain more importance than probably in the international geography. SEBI has been making a lot of efforts to strengthen the related party framework compared to the MCA, because SEBI has gone ahead in November 21 has come up with the new related party regulations as a part of the SEBI listing obligations disclosure requirements in regulation 23, where they have taken a very unique position. They have defined related parties and they have separately defined related party transactions. Now, if you commonly understand that related party transactions are only those transactions with the related parties, under SEBI, you will be wrong. Because under SEBI, related party transactions include transactions of a parent with the related parties, even of the subsidiary, even if the related party is not a related party of the parent. So they have tried to expand the scope of related parties under SEBI. But unfortunately, MCA or Schedule 3 has not picked up the same change. And therefore, only listed entities get covered into these new regulations. And that too, these disclosures are not mandated as a part of the financial statements. So there is an inconsistency in the way how auditors look at related parties in SEBI, even though they don't get reported as part of financial statements, and the way in which they look at related parties under the Schedule 3 requirements. The second concern I have is, I've told it in my opening remarks also, the standards, regulations, extra, everything are only minimum requirements. Just because you're doing the minimum requirements doesn't mean that you're doing it right. I would like to see audit committees come up with a related party policy framework, which includes their own definition of related parties. That is very, very important because, pardon me for my language, but Indian corporates know how to circumvent the law. And therefore, be it a related party regulation under the regulations, but in substance, they're related party relationships. I'll give an example. We had a client which was lending money to a corporate. It was not a related party, no common directors, no shareholding, nothing. But that company was being formed by the managing director and run by 2 employees, former employees. These employees are used to working under the direction, supervision, and control of the managing director. Now, in substance, is this a related party? I would say definitely yes, it's a related party because, but for the relationship of the MD with these 2 employees, this loan wouldn't have been given. But it is completely circumvented the requirements for related party disclosures and requirements. Money was given, money was lost also. And only the management was caught, but then again, I don't know where they stand finally in the litigation. Auditors, we got scot-free because we said it's beyond our scope of coverage, etc. But my point is, as auditors, are we also doing more than what is the regulation requirement to identify these sort of transactions? Nothing stops us. The regulations give us the minimum safeguard, but that doesn't mean that we should stop at the minimum safeguard. We should do what is right. That is missing in the current practice. The second thing I find very peculiar is most of the related party policies of companies, if you see, which is there in the website, you see there is no real clear definition of what is a transaction which is not in the ordinary course of business. And I have got clients who have come back and told me, whatever is permitted in my memorandum of articles as my objects is normal course of business. If I say that, that means every transaction is on the ordinary course of business because I can't do a transaction which is outside the objects. That means every transaction is in the ordinary course of business. This is completely absurd. Therefore, as auditors, we should push the audit committees to come up with better sense in terms of how they should define these things. Today, SEBI in the regulations have come up and said how the audit committee should look at the arm's length pricing. They have given a lot of criteria for that. Now, none of these policies were there in the related party framework of the companies which were issued before the SEBI regulations. Now, why as auditors, we have not been able to go back to the corporates and say, we are not comfortable? Because today as auditors, we are signing in caro that the company has complied with 177 and 188. How did we sign off on that compliance when the company itself did not have a framework to identify arm's length nature of transaction or what is in the ordinary course of business? So I really question every audit report. Nafra should not take this up, but the point is, as auditors, we have been in support of the management rather than really being the trusted advisor which the management needs. So we should strengthen our process on the related party transactions and the disclosures. Coming back to SEBI regulations, the enhanced, so one of the fundamental things which every company missed in India, I don't know international, but definitely in India is, if you look at India as 24, it says the objective of the standard, including the disclosure requirements of the standards, is you will disclose the account balance and commitments to related parties. That means, if in example, if an automobile manufacturer signs off with a subsidiary that he will sell 1,000 cars, and he has sold only one car as at the year end, he has a commitment to sell 999 cars. Is that being disclosed in any audit report, any financial statements? And auditors have happily said that you are in compliance with accounting standards because accounting standards need this disclosure. Now SEBI has come up with a format which asks you to track these commitments and then disclose it. But unfortunately, SEBI has not insisted on this being audited as a part of the audit of financial statements. It can at best covered only as a part of the corporate governance certifications, which may or may not be done by the auditor. But why is the same disclosure not even being made in the financial statements? Shouldn't the financial statements disclosures be enhanced and also at least made compliant with the standards? That is something the corporates needs to think and auditors needs to be aware of when they do their audits of related party transactions. The other question I have with the auditors is, how do the auditors test the arm's length pricing? Because the management says the pricing is X, we go with the pricing as X. There's no real testing which is being done. In fact, I have had excuses by the management saying, no, this is covered as a part of transfer pricing. Arm's length is established in transfer pricing. Auditors should point out this transaction happened last year. Transfer pricing is finalized next year in November. And that too, the auditor is only certifying the related party transaction. He's not certifying the transfer pricing under that Form 10 CEB certification. So transfer pricing is not really an evidence available at the point of at the time of transaction happening. So at the time of transaction happening, how did the audit committee conclude that something? It is not certainly based on transfer pricing. That is a very wrong excuse which the auditor should never accept. So these are pointers which I wanted to bring out on related party, because this is an area where if you look at all the reported frauds, almost 80-90% of them will relate to related parties. And obviously auditors get questioned, what were the auditors doing on the related party transactions, both for undisclosed related parties and transactions which are not in the normal course of business. Why do they keep quiet? So the caution here is that auditors should be more skeptical on related party transactions. And morning one example was given, saying that when the survey was conducted, distrust was the biggest pointer, identifier. I think the survey did not include any auditor, because if the auditor was asked, he would have said trust is the first point because I always trust the management. Auditor is not part of the survey, unfortunately. That mindset should change. Auditors should also distrust the management in a related party transaction. I should always consider that as a presumed risk of fraud. I'm also concerned why the institute is not picking it up. Institute also should be saying, no, see, today we are all saying we need guidance. Now then let the institute give the guidance to say that under the SA 240, it's not just revenue and management overall of control. RPD is also a presumed fraud risk, but with a rebuttable presumption. Let the auditor argue why it is not a fraud risk. But the starting point is it's a fraud risk. Why is that presumption not being brought in? Why are we hesitant to that? When we know that we are having this problem continuously. So these are some pointers on related party which I had. Thank you.
Thank you, Balaji.